Great. Welcome to the Vermont House Appropriations Committee. It is Tuesday, February 21, 2023. It's going to be an incredibly busy week, many things on our agenda. But first up this morning, we're running a little late because we had some technical difficulty with getting on live stream, which thank goodness for the tech support that we have in this building, who can come and I swear fix things better than MacGyver with duct tape and bubble gum and get us back up and running. So here we are. We're going to start off today hearing from the Vermont Pension Investment Commission. And Thomas, come on over and take a seat. You don't know all of us, so we'll introduce ourselves and then you can introduce yourself and then tell us about your budget. So I'll start off. I think I had super high test coffee. I can feel it. Simmer down. Water. Yeah. I'm Representative Diane Lanfro. I live in Vergennes and I represent Addison 3.
Hi, I'm Robin Shy from Middlebury.
Pat Brennan from Colchester.
Tiff Blumley from Burlington.
Carrie Dolan from Waitsfield, and I represent Facein, Moortown, Duxbury, Waitsfield, and Water.
Lynn Dickinson, I represent St. Albans Town.
Hi, I'm Martin Holly. Welcome. I represent Calais, Plainfield, and Marshfield.
Page from Newport, and beside me would be Trevor Squirrel from Underhill.
I'm Rebecca Holcomb, Norwich, Sharon, Stratford, and Dufferin.
Morning, Tom. Jim Harrison, Chittenden, Mendon, Killington, and Pittsfield.
Great. And for the record, sir?
All right, I'm Tom Blanca. I'm chair of the Vermont Pension Investment Commission. I've been chair since 2016-ish. So I've been, myself and the 3 staff people have been instrumental in moving off from the state treasurer's office, as well as implementing the state pension plan here in the state. So we manage the pension assets for the teachers, employees, and the municipal employees. And we have about $6 billion. So it's a fiduciary board made up of about 12 people, representative from governor's appointees, VEMR's appointees, VESTers and VESTers appointees, as well as the League of Cities and Towns and Education, Board of Education. So we have, I think, an awesome responsibility to steward, the assets of the state. And I think we've done, it's been an interesting past 5 years, going from operation of the state treasurer's office through Act 75, moving off into an independent entity, hiring a chief investment officer who's on the phone as well. It's Eric Henry, who manages our day-to-day operations with 3 staff people. We operate out of the building just down the street. So thank you for having us here. It's our second budget cycle, so bear with us if we make errors or have questions about the process. Before, we were just part of the treasurer's budget. So now it's a separate entity. I think it gives us more transparency, as well as helps us understand, the process in the state. Part of Act 75 had us complete a compensation study. So I think that's very appropriate for this committee to understand. We highlighted that. We haven't really implemented that yet in the budget process, but had some significant findings in regards to how we pay our staff, how we underpay our staff, and how we should look at it over the next couple of years. And so we've had discussions with the administration, and one of the recommendations was to work towards some exempt executive pay plan structure for the 2 other employees that we currently have. So in the budget today, you'll see that there's 3 employees, one of which is exempt, 2 of which are not. We'd like to respectfully request that we exempt those other 2 employees and then work with the state to come up with an exempt pay plan. And the reason for that is the compensation study that we submitted to the legislature reported that we were at 10% of peer group in regards to our compensation. And we really have a significant risk of losing our employees if we don't do something over the next 3 to 4 years. And so I'm setting the seeds of what we would like from VPIC. The budget currently is spelled out. We have it's a little bit higher than last year, I think about 5% higher than last year. And that's made up from Agency of Administration has done a tremendous job in helping our staff put together this. I'd be happy to answer any questions about the budget or the exempt status or what we're looking to do.
Yeah, I would like to know a little bit more about what you're asking, just to make sure I get it written down correctly, because this is, what you're asking is above what the governor's recommend is, correct?
Well, yes, we'd like to ask for a little bit in increase. The governor's asking 2 million. The governor's budget had 2.2, I don't have my glasses, 5.9.
Is this the governor's budget or your budget?
The only difference between the governor's budget and our budget was that we had asked for another person, and the governor took out the extra person in our requested budget. The rest of it is in line. The only difference from that to today reflects our executive compensation study that came out of Act 75 that we just received at the end of last year. And that's why we haven't added an amount in yet, but to get to the level that's recommended in the comp study, it would take about $350,000 increase over a 5-year period. So we were thinking if we were to split that up over 5 years and add that to the budget, we would then be able to go to the governor's office and then start to come up with some type of executive pay plan. But everything else in the budget, we do agree with, and we worked with the administration to complete.
So thinking this is Lynn's budget?
Well, I have treasury and I have the pensions for the VSCA.
Right.
So I might have you in my category.
And Eric, who's on the screen, can go into more detail in regards to what he thinks and some supporting information that would help.
Okay, I just want to make sure that Representative Dickinson, who has this budget, then has it doesn't need to be right, a full understanding, if not out, but at some point,
Sure.
understands what you're asking for in above the governor's recommend and how that's going to work. Okay.
So let me just
Go ahead.
summarize what I hear. This crosswalk does not reflect what you requested. You had another position in here, and the governor did not put that into the final budget.
That's
So you're
correct.
missing one person.
We're missing one person, and then since that time when we completed the budget, we came out with our comp study plan, and that's where we think we need a little bit more in that regard to be able to meet the recommendations that were in that comp study.
Okay, so that is over 5 years, the change from classified to exempt for the two people that lost.
That's correct.
That's a 5-year plan.
Yeah, it's fine. We'd like to get them exempt and then work through get them as soon as possible, then work through the Department administration to come up with an executive pay plan for those
Okay,
two
good.
employees.
Thank you. I think I get it.
And the reason for that is the classifications don't really work for our pension employees. There really is no easy way to put them in any of the financial analyst position. And if we were to change those categories, it affects thousands of other employees. And so we feel an exempt employee structure would be a lot more appropriate.
Yeah, thank you.
All right. You good, Representative Dickinson?
Yes, thank
All
you.
right, Representative Shy.
I thought I had it, and then you said something, and now I'm
Yeah.
confused. So currently, how many people do you have? Do you have 4 or 3?
3.
You have 3, you need a 4th.
We need a 4th.
Okay, and then that 4th is one of the 2 that you want to switch from classified to exempt? Or would that 4th
No, that-
come in as exempt and you need to switch the other 2?
No, the 4th would come in as classified. It would just be an admin person to help with, it could be a
Okay.
financial analyst position. We need 2 more exempt positions. So we were thinking reclassify or exempt the 2 existing positions and then potentially add in a 4th person.
So, okay, so the 4th person would be classified, and ultimately the other 3 would be exempt.
That's correct.
Right now, only one of those 3 is exempt.
That's correct.
And then the 350 compensation, you're talking about over 5 years. So does that mean you would want 70,000 this year?
That's what I was thinking. And the reason for that 350, it gets us from 10 percentile to 50th percentile. And the recommendation is to create positions that we would then be more competitive in the marketplace if we had to replace them. That's the risk we run. And there's significant key person risk in this office.
Yeah, no, that makes sense to me. And this all comes out of special funds?
That's correct. It all comes out of the
So
pension.
general fund money?
There's no general fund money. It all comes allocated based on the asset base of each of the pension funds. So teachers pay a certain percentage. I think it's about 40-some percent.
Yeah.
Employees pay about 40%, and then munis pay the difference, which is about 20%.
Right. Okay. Okay. Now I understand.
We can,
It just got a little deeper. Representative Harrison?
I'm good.
Okay.
She asked my question, so I'm good.
Great. So, Was that your hand, Representative Dolan, or just your? Okay. Oh, Representative Dickinson?
Okay, yes, you have a switch from special funds into all other funds. You've got codes there. Is the 21520 the other, that's the asset base?
Yes. Yep.
Okay, so you're taking that out of there and you're putting it into special funds. What's the special fund? What does 21521 refer to?
Would be the agency administrator. They should.
Sure, I'm Ethan Hurley with the Agency of Administration and Financial Services Division, the financial director for VPIC. So the two funds, the 21520 and the 21521, one of those funds is the transfer that comes directly from the treasurer's office. In that first year, as VPIC has moved out of the treasurer's office into a standalone entity. So moving forward, we would see all of the funds just in that one fund base. This is really a reflection of the transition from VPIC being part of the treasurer's office and moving out onto its own, and then also finding the footing of how the funding works on a functional, practical basis.
Okay, thank you.
Can I just follow up? So the 21520 that's in the other, that's a special fund account that's in the treasurer's office.
Yes, that
So
was
you're moving it from there over to.
21520, which is the $522,000, was a one-time transfer from the treasurer's office
To,
to VPIC
yep.
in the FY23 year.
Okay.
Thank you.
Thank you. Oh, Representative Mahali.
Two questions. One, do we know where this resides in the budget?
Well, that's what who's got the treasurer? I thought it was.
Where is this in the B?
B134.1, I think, because I just found it.
Yeah,
Is that
I've been
right?
looking online.
Sorry, while we,
That's okay. It's new to me too, so.
Vermont Pension
Did you find it?
Investment Commission is B134.1.
134 point, oh, yep, that's the one. Okay.
Second question, I can't resist. So how long do you think, as I understand it, the current pension calculations are based on a 7% return? How long do you think that's going to endure?
Interesting question.
I just couldn't.
Five, don't, I know.
There's a lot of factors that go into that. Capital market assumptions have gone up a little bit, and so I think we're a little bit safer than we were with the lower capital market assumptions. That being said, there is some current legislation in place that could cause that to come into jeopardy. That could cause us to significantly have to change our investing process and processes, and potentially cause us to lose access to private equity, which has been really our.
I see.
So the other bill in the Senate right now is causing me concern about that issue. I think there's split on VPIC right now. So as you may know, VPIC now has the responsibility for setting the assumed rate of return for the pension fund. It's currently at 7%, as you said. States have been lowering those rates, and it's been marching down.
Because of the market, the larger.
Yeah, because of the market, maybe because of bond yields. Bond yields have been significantly, haven't been able to, through our capital market assumptions, met that completely. Now, some years we do, some years we don't. Last year we did. There's going to be debate this year over whether or not it should be 7 or whether it should be 6.75 or whether it should be lower or higher if the assumptions come in. I try not to guess that yet. I do think it is going to be an issue that comes up. Now, the significant issue of that is if we do lower the assumed rate of return, it can have a $50 million increase in request for the budget. And so you got to understand every 50 basis point drop is a significant change in a budgetary request. We're cognizant of that. We're trying to make the best decisions we can about it. What we've done at VPIC to really address that is lower costs. We've really addressed, fees. Fees over the past couple of years have basically remained the same. So if you look at back when I took over as chair, fees for VPIC probably were all in about $26 million. We pay now probably about $25 million all in, and we have twice as much in terms of assets. And that's a reflection of us indexing. We pay about 2 basis points for our index funds, both equity and debt. And also, we've really ramped up a significant private equity, private debt, private real estate portion of the portfolio. That's allowed us to maintain the 7%. You know, if you look at our returns on our private equity, private side, we've realized about 1,000 basis points outperformance on our private side. And so we felt and we feel that as long as we can maintain those strategies, both indexing and private equity, we'll be able to maintain that for now. Markets can change, and so we're cognizant of that fact, and we will go in it with a lot of debate and a lot of discussion, particularly with including impacts from the VEMR's, BEASTers, and BEASTers boards when we get to that step. We're not there yet. I think current legislation could cause us to get there quicker, but I think—
You're talking about divestment?
I'm talking about divestment.
But is that because you're worried about higher fees from all the funds that are ex-petroleum?
No, I'm thinking there's a part of it. And Eric can get into more detail about the specifics, but divestment bill would prevent us from going into the private equity space. Not necessarily because they have fossil fuel stocks. It's because we have 10 to 15-year contracts. And you can't tell managers in limited partnership groups, you can't do this. You can tell them, they'll just say, well, thank you, you're not invited anymore. And so the end result would be we wouldn't be able to get into the top quartile funds in those asset categories, which would mean it wouldn't be worth going into the exercise because they're more expensive. They tie up our money a longer time. So if you're not in the top quartile, it's not worth it. And so the fear, if we have to divest the funds of every fossil, or the implication of getting into any fossil fuel in the future, it's sort of this chicken and the egg. You just can't. You can't tell managers what they're going to do, even if they don't have any. You know, our whole portfolio has probably less than 3%, I would say.
Yeah,
so I'd argue we're 97% fossil fuel already. The question is squeezing out that last 3% is so expensive. The second step is we probably couldn't index the way we do, and that would double our costs internally on indexing. And so there's a two-tiered effect with that at this point. We've at VPIC have used the opportunity for engagement and working with companies to lower their fossil fuel exposure versus just saying flat out walking away from the table. So it's been a different strategy that VPIC has employed. So that's our biggest concern over the assumed rate of return.
Thank you.
Representative.
And just to be clear, I'm not in this pension fund, so this is not a conflict of interest, but how are you planning for and accounting for the deterioration in the ratio between active and retired members in some of these plans?
Well, we manage it through cash flow. So we really, and it may be an issue, we monitor cash flow as part of our asset allocation strategy. And so it is an issue, how much comes in versus how much goes out. That's figured into the actuarial assumptions and the ADAC that's funded the plan. We may need to change the asset allocation for teachers versus municipal employees versus employees. So we may have to do something like that, where instead of having one uniform asset allocation strategy, we may have 3 different asset allocation strategies for the different pools of funds. That also goes into effect. We may work with the Treasurer's Office for the OPEB funds. And so we may have to have 4 different asset allocation strategies on that. But it'll be, a careful, thought out process. And we really look at a liability strategy. So we understand what our outflows are going to be with the teachers, employees, and munis, and that will guide and it may impact our rate of return assumption if we do have to increase our liquid investments and lower our investment rate of return. That may be one of the end results.
Good. Representative Harrison?
Okay, I just want to repeat something because I want to make sure I heard it right. There's going to be some conversations about what the rate of return is or should be. And those are healthy. We can't sugarcoat it. We got to have them. And the market's the market that none of us have control over. If it is lowered to 6.5%, what did you say the annual contribution impact would be on our budget?
We asked Siegel that last week. So we asked our actuaries to give preparation for our testimony at Seneca Ops. It was about $50 million extra in the ADAC payment, both for this year and going forward. Through 2038, which is the amortization period, it totals about $750 million. That's what the actuary told me.
$1 million per year.
Until
increase on top of the over 300 million that we're contributing now.
Yes, and $750 million through the amortization period 2038.
700.
For it. And so it's a significant question.
Additional 750 million?
No, that's this 55. So if you're just,
Okay.
yeah, between now and 2038, that extra contribution level would total about $750 million. And that's what the actuary told us for the last week.
Okay, my other question, because inflation this past year has been higher than normal, there's been a bill introduced to raise the cap on the CPI adjustment for teachers. I don't know if you've looked at that, and does that have an impact on the unfunded liability?
Well, if you recall, the biggest negative for the adjustment last year was the COLA adjustment. So the cost of living adjustment on the unfunded liability calculation actuary comes up with. The biggest negative number last year was the COLA adjustment. And so I think it does have a significant issue, and it is a significant contributor. If the actuaries don't predict the proper inflation rate, they're going to have to make up for it in unfunded liability. So it's really a matter of pricing the normal cost correctly. And if you can get the normal cost priced correctly, and that's all these different components, that's been the challenge. Actuaries will do that. And as we get closer to 2038, it becomes more and more significant because you have less years to amortize the unfunded liability. And so the next 10 years are going to be quite significant in how that plays out, both from a market perspective, inflation perspective, and contribution. I don't want to sugarcoat it. It's a challenge. It's a tremendous challenge. And I think we're getting a better handle of it. I think over the past 5 years, we've made tremendous progress in understanding what we're doing here locally. We're not, we've cut costs pretty well. We've gotten really good fund managers, and we have a good internal staff. I just want to make sure that we maintain that good internal staff, because if we have to go back to what it was before, we're at the mercy of Wall Street. And Wall Street will charge us a tremendous amount of money to manage this, much more expensive than what we are paying right now. And goes to the fact that 5 years ago, when we started this process, we were paying more than we are now. And I think that says we were paying about 63 basis points on average. And it doesn't sound like a lot, 63 basis points. But on $6 billion, that's a difference of, $10 million, $20 million, $30 million, $40 million over time. It's quite significant on a fee basis. So that drag on fees that we've been able to squeeze out has been tremendous. And I credit that with our internal staff. I think they're probably three of the most valuable staff people that you have here in the state. And I'm a little biased. I'm a little biased. But they made $1 billion 2 years ago when the markets were up 26%. And that's the potential. We're going to get out of this through good investment management, proper payment of the normal cost, and proper admission of what the normal cost is, and possibly having to reamortize. I hope you don't, but possibly having to reamortize it for 2038, for 2041, or something of that nature, particularly if we have a bad year. But you can't have shocks to the system, and some certain shocks would be radical changes to our investment plan, and that's what I hate to see. And that's why I'm advocating for an extra position, and that's why I'm advocating for trying to fund our current positions up to a comparable level. If we have to replace our staff, I think it would be very difficult. Staff has tremendous opportunities remotely now, as well as through it can work for New York companies and Boston companies remotely now versus before they couldn't. And so the old argument of people want to come to Vermont because the quality of life doesn't really hold anymore in the investment world. So I think that's the priority. And so being able to work with the governor on exempt payment plan would be instrumental for the next couple of years.
You good, sir? Mm-hmm. All right, Representative Dickinson, and then I want to get back to your budget. We love to get underneath other issues with somebody's here, but
Face to Wall Street, 63 basis points.
That's what it was. It's down to 43.
What are you doing now?
43.
And that's because you're doing it with your own staff?
Yes.
The 3 people.
We've been able to use the internal staff to both index where possible, and where not possible, we've been really, we own everything. So we've been able to potentially really look at the portfolio from an individual fund by fund manager approach, as well as get rid of stuff that we think doesn't have a place here in the state of Vermont. A couple of years ago, we had this fund called Allianz Structured Alpha. And I don't know if you ever heard of this, but it belly up, and it cost Blue Cross Blue Shield their pension plan because they had most of it in it. We had that fund. Our current internal staff identified it as a problem fund, even though our investment advisors from Wall Street said it was a top pick. They had VPIC sell it. And so we saved $100 million loss on that. And so it's those things under the hood that you don't see or hear about that I think are tremendously valuable here for the state. Blue Cross Blue Shield went belly up for their pension plan. And so we want to avoid that. And that's where we come up with the critical internal review of each of our fund managers. We have 44 managers, and the 3 staff people are reviewing all of these, managing cash flows and managing the pension funds and working with the board to help us understand it in a better way.
Thank you.
Good.
Huge difference.
Representative Holcomb?
I just have to feel compelled to make an observation that sometimes we get what we pay for, and that's a reality. And I appreciate you're willing to be in public service. I also know that there are other positions in state government that manage people who make 3 times as much as they do. So this is not unique to this particular entity.
Yeah.
This is an endemic problem.
Yep.
And this is critical, and I know, I remember hearing from previous folks, legislators who are no longer here, who just said that the moves that we made and that you made and your staff just have been, just made a huge difference in what we were having to deal with renegotiating.
Yeah, I think the next step really with moving out of the treasurer's office, as well as potentially working with them on OPEB, are going to really help in that process as well. So I think we're making tremendous progress. I want to see it continue, and I want to give the support to Eric and his team as they see fit.
Yay, Eric. So Tom, I just want to go back to your budget to make sure that we understand your ups and downs here and what you need. We've got the what you need ask, I think, down, but it's all in special funds. You've got salary, the switch from the treasurers. I'm looking at your crosswalk
We
there.
don't have the cost of a new person.
Eric could highlight that. He's on the phone right now.
Essentially, we'd be looking for an investment accounting type position. It's probably an $80,000 a year base salary.
Does that include all the benefits? We should have the all-in number.
Benefits would be on top of that. I think the number came out around 120 total.
Yeah, that's the one they took out. So it was a fund accounting position, which would be tremendously helpful for our 3 staff.
You requested it and it wasn't
That's correct.
put in the budget.
So you must have data on what that is. So that would be very, very helpful to send us the actual details of it.
We'll give you the.
Consider, we're not promising. We've got a lot of asks on the table.
Well, I figured I didn't ask you.
You've got to ask, right? If you don't ask, it doesn't.
Ask it just for the 2 things. If I didn't ask you, wouldn't even consider it, but we'll get you that number.
Great.
And the info on the 70,000.
Yep.
Right. Yeah. As much as we all take good notes, let's not rely on just.
We'll send you a report.
Yeah, and particularly make sure that Representative Dickinson is well informed on that, and we'll put it in your.
Okay. We'll send it directly to her.
Any other questions for the gentleman? All right, you are free to go.
Thank you very much.
Thanks for all you guys do.
Thank you very much.
Have a good day. I know, once we've been, I don't know about you, but once I've been, gone out for 3 days, I forget how to drive the bus here.
Somehow I don't.
All right, we've got a little bit of a break. We can catch up on our time because if it's okay with you, that till 9:15. And then we have coming in as the executive branch. And then at 10 o'clock, we have Sarah coming in, which is probably go over the web report on the BAA. Take a look at the difference in numbers. And like I said, that it's going to be on the floor in the Senate and they have amendments. So the final isn't totally there yet. And then at 11, we have state colleges. I know I'm reading, Lunch, Lieutenant Governor, Adjutant General, nice. And then our public hearing later. We have a break. Yep, yep. And just so you know on that, if, I don't think I've communicated that, have had good communications with our counterparts in the Senate. And the senators are going to stay in their room. They're not being sequestered, but Senator Kitchell's going to come over and join us. So her and she'll call the witness and I will work on the timing. So I did all I could, Representative Page, to make sure that I could secure your seat from being moved around.
So instead, one of our seats is going to.
Yeah, so we're gonna, yeah.
So you're taking
Representative,
Jim's
no.
seat or what?
So,